Welcome to Wealth and Means, advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode starts with what you didn't see in the news, where the quiet stories show you the next trade before it shows up as a headline. Palantir turning from ticker to symbol. Uranium and energy sovereignty crossing through markets, trends, and geopolitics. On-device AI shifting power from data centers to hardware. Risk-off tech and dividends sneaking back into style. Voice cloning forcing a new trust layer. And the weird internet's new obsession with burst work. Locked-in routines, hygiene as luxury, crochet as commerce, and a full-on 2016 reboot. Then it's wake up ready. A junction week as February starts. China and U.S. manufacturing, labor and credit signals, central banks in Europe, and Friday's jobs report as the anchor. After that, knowledge bomb, deflation, inflation, hyperinflation, and why volatility is the admission price. Humor me follows, where unprecedented gets roasted and the market keeps dancing. Then the greater debate, financial repression as bridge or betrayal. And we close with Let's Invent Again. A basement lab, a flickering screen, and the bridge technology that made modern computing usable.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. Here's what you didn't see in the news this week. Not the loud stuff. The quieter stories that were building momentum in the background.
The things that show up in your feed before they show up in a headline.
Let's start with Palantir, because defense tech is suddenly back in the retail conversation. And not in a niche way, in a thumbnail way, in a here's why this stock matters way. Mentions and explainers accelerated across creator channels this week, framed as AI plus national security plus big picture relevance. And that framing matters. When a company stops being a ticker and starts being a symbol, money follows the symbol, not the spreadsheet.
That's when it stops being a trade and starts being a personality.
And it connects to something bigger. Energy sovereignty is having a moment again. Uranium names started crossing through stock chatter, Google Trends, and geopolitics at the same time. Not just nuclear is back, but who controls baseload power in an unstable world? When energy becomes strategic again, capital starts treating it like defense. Less cyclical, more existential. You see the same theme becomes the asset pattern in solid-state batteries. The story is trying to graduate from science fair to supply chain. Automakers, breakthroughs, safer chemistry, denser storage, all landing together. Enough to make it feel real. Batteries are still the choke point for EVs and grids, so every upgrade pulls on policy, CapEx, and materials politics. Momentum is the currency. From energy to chips, because if energy limits machines, compute limits intelligence. On-device AI had a real moment this week. More talk about who runs models locally, less about who owns the biggest data center. Qualcomm-style, Apple-style framing spreading across podcasts and clips. Local inference changes privacy, latency, cost, and power. When capability ships in hardware, platforms get stickier.
And suddenly, upgrades matter more than subscriptions.
Which feeds into a quieter market shift. Risk-off tech. More attention flowing to profitable dividend-paying tech companies. Less patience for pure AI dream stocks. Investors aren't abandoning innovation. They're asking it to come with cash flow. Reliability is back in fashion. And once AI is local, the next question is, what happens when the voice isn't real? Voice cloning is back in the spotlight, not because the tools changed, because the incidents got shareable. A few high-signal examples, Elon Musk and other bosses asking employees for money, and suddenly everyone's arguing about trust again. Voice was an authentication layer people didn't know they were using. Now it's fragile. Scams get cheaper. Reputation gets easier to attack. Platforms get pushed toward verification. Then zoom down from geopolitics to personal balance sheets. Fintech is back in everyday money conversations. SoFi picked up momentum in creator finance circles this week, tied to earnings and the bigger question of whether consumer credit is bending or breaking. Fintech stocks trade like confidence meters. When their narratives move, something underneath is moving. That same math-first framing shows up in solar. Enphase mentions climbed in renewable podcasts and energy circles. Not framed as save the planet, but does this still pay? Residential solar is a financing product wearing a hardware costume. Rates, incentives, and installers matter as much as panels. When they line up, attention follows. Staying in the less flashy, more real lane, UiPath, automation is trying to reclaim oxygen from pure AI hype. RPA mentions ROSE this week, framed around workflows and budgets. This is where AI gets tested, not in demos, in invoices. When this rises, CFOs are paying attention.
Nothing spreads faster than show me the ROI.
Meanwhile, the internet keeps trying to rebuild its own infrastructure. Decentralized social resurfaced again, Mastodon, Farcaster-style ecosystems, usually triggered by friction on big platforms. It's not about ideology, it's about exits. Parallel identities change bargaining power. Which brings us to the reminder of the week. Platforms break. TikTok and CapCut wobble, creators panic. Outages and trust shocks drove what happened searches and threads. Not about features, about reliability. Creators are small businesses. Workflow fragility is business risk. Every glitch pushes diversification.
Nothing motivates multi-platform strategy like a project that won't export.
On the productivity side, there's a deeper shift happening. The end of consistency narrative is spreading. Less worship of the 10,000-hour grind. More talk about flow states and burst work. Work in sprints. Rest. Re-enter. Weird internet productivity subcultures are growing around this idea. Not hustle culture. Not slow living. Something in between. People aren't trying to be disciplined forever. They're trying to be effective in waves. That connects to the rise of locked-in accountability content. Less advice, more performance. Watch me do the routine. Watch me lock in. Habits as spectator sport. Tools that support tracking and community become distribution engines. Next to that, hygiene as luxury. Shower routines, grooming rituals, reset content. Treat yourself, but make it repeatable. When big luxuries feel risky, people move to small, controllable upgrades. That moves real money in beauty and replenishment. And then there's crochet, quietly exploding. The crocheters of TikTok moving from niche hobby to fashion-adjacent micro-industry. DIY tops, bags, patterns. A creator niche scaling into mainstream discovery. TikTok microtrends often map directly to search spikes and product demand. This is what that looks like in real time.
From yarn to yield curves, only on the internet.
Let's go global. India's budget chatter spiked this week. Fiscal policy turning into social content. In a fast-growing economy, budget signals ripple through banks, infrastructure, currency expectations. Hashtags bundle 1,000 implications. And on the messier side of geopolitics, Sudan resurfaced in online communities. The civil war there sadly crossed the notable 1,000-day anniversary.
The news forgets. The internet remembers, eventually.
Then there's nostalgia. 2016 is getting rebooted. Music, fashion, visual language. Mid-2010s becoming a template. Nostalgia is low-risk creativity. Familiar travels faster in fragmented feeds. After all, who could forget Pokemon Go, Stranger Things, and Drake's One Dance? So zooming out, 3 patterns. 1. Attention is moving from abstract systems to controllable surfaces. Phones, power, workflows, routines, crafts. 2. Trust and reliability are becoming products. Energy security, dividends, voice authenticity, platform stability. 3. People are optimizing for flexibility over permanence. Burst work, exit options, templates, remixable formats. That's what you didn't see in the news this week. Not the biggest stories, the ones quietly recruiting believers. Now, let's wake up ready. All right, here's your week, February 2nd through February 6th. Junction week, big tech earnings, Europe's central banks, and then Friday's jobs report as the final exam. Let's walk it so you're not trading your emotions in real time. Monday starts overseas with China's Caixin manufacturing PMI. Plain English. Are Chinese factories seeing more orders or not? The question is whether China's industrial engine is strong enough to pull demand through commodities and global trade. Markets care because China is still the marginal buyer for a lot of metals, energy, and shipping capacity. A stronger print can lift cyclicals and commodity-linked FX. A weaker one tends to drag the growth is patchy narrative back into focus. It popped this week because it's the first big global read in a week that ends with U.S. payrolls.
The tone of the week gets set before the U.S. even opens.
At 10 a.m. Eastern, the U.S. gets ISM Manufacturing PMI. Translation: how the factory floor is doing. Orders, production, hiring, prices. The question is simple. Are we stabilizing into expansion or still grinding? Markets care because it nudges rates and hits the activity-sensitive parts of the tape: industrials, materials, and anything tied to demand. Hot print, yields firm and cyclicals breathe. Cold print, bonds rally, and defensives get their moment. It matters this week because it's one of the first clean January signals. Same window, construction spending. Are real dollars still flowing into building, public and private? The question is whether infrastructure momentum and CapEx confidence are holding up with financing conditions where they are. Markets care because it's demand for inputs, steel, copper, aggregates, and a read-through on real economy follow-through. Upside supports materials and industrial suppliers. Downside raises the odds that projects are pausing. It's getting attention because everyone's hypersensitive to tangible growth signals ahead of Friday.
It's a quiet report that can either validate CapEx optimism or quietly poke a hole in it.
Monday night shifts to earnings. Disney reports after the close. What's happening? Streaming economics and parks margins. Basically, is the flywheel spinning profitably? The question is whether streaming losses are narrowing without parks losing momentum. Markets care because Disney is consumer demand with a balance sheet. Guidance can swing sentiment across media and discretionary. Strong results reinforce resilience. Weaker guidance can weigh on the broader entertainment complex. It's in focus this week because markets are sorting pricing power winners from everyone else. And also post-market, Palantir. The question is whether commercial AI contract growth is actually accelerating, not just being narrated. Markets care because Palantir trades like a theme proxy, defense plus AI analytics, so surprises can spill into adjacent AI infrastructure and defense tech narratives. Beat and you can see a reflexive risk-on bid, miss, and it can unwind fast. It's a Monday event, so it can set the tone for how investors treat AI story stocks heading into mega-cap tech.
With Palantir, the numbers matter, but the wording in the deck matters almost as much.
That's Monday, factories in the morning, belief and consumer signals at night. Tuesday is labor and credit with a side of sector reads. Tuesday at 10 a.m., JOLTS job openings. Plain English. How much hiring demand is still out there and how much churn the labor market has? The question is whether openings are cooling in a way that reduces wage pressure without breaking employment. Markets care because it feeds rate expectations. Cooler supports the cuts later camp, hotter keeps higher for longer alive. Cooler jolts can ease yields and help duration equities. Hotter can tighten conditions quickly. It's in the spotlight because it's the first big breadcrumb before Friday's payrolls. Then at 2 p.m., SLOS. The Fed asking banks if they're tightening or loosening lending. The question is credit easing back into the system, or are banks still cautious? Markets care because credit is the transmission line. Tightening slows growth with a lag. Easing can support small caps and housing-adjacent names. Tightening can pressure cyclicals and raise consumer credit anxiety. It pops this week because markets are trying to reconcile strong asset prices with the day-to-day reality of borrowing costs.
It's the rare report that's basically forward guidance from the banking system.
Pre-market Tuesday, Pfizer reports. The question is whether the pipeline and guidance can carry the story post-pandemic. Markets care because big pharma often anchors defensives, and guidance can move the broader healthcare complex and biotech sentiment. Strong results can support a defensive bid. Weakness can spill into the sector's risk appetite. It's relevant this week because healthcare can quietly steer sector leadership while tech dominates the headlines. Tuesday also gives you energy and autos. The API crude inventory report hits at 4:30 p.m., a private snapshot before the official numbers. The question is whether inventories are drawing or building and what that says about balance. Markets care because oil reacts fast and energy equities follow when positioning is tight. Big draw can lift crude and inflation expectations. Big build can soften both. It matters this week because energy is trading fundamentals and geopolitics simultaneously. And the National Auto Dealer Show 2026 opens in Las Vegas. The question is whether dealers are seeing demand hold up and whether they're investing in tech-enabled retail or tightening belts. Markets care because autos are credit sensitive. This is a real-time sensor for durable demand and financing conditions. Strong tone supports autos and lenders. Cautious tone reinforces big-ticket spending is slowing. It's on the radar because it lands right in the middle of a labor-heavy week.
Dealers tell you what consumers are willing to commit to, not what they say in surveys.
Wednesday is where the week compresses. Labor preview, oil reality check, policy on minerals, and then the big tech double feature. At 8:15 a.m., ADP employment. The question is whether hiring momentum is holding or fading heading into Friday. Markets care because even with its flaws, ADP can move rates and futures as a positioning catalyst. Strong print can push yields up and firm Fed expectations. Weak print can do the opposite and fuel a bond rally. It's in focus because everyone's braced for payrolls. At 10:30 a.m., the EIA Petroleum Report, the official inventory numbers. The question is whether supply-demand is tightening and whether product inventories hint at consumer demand. Markets care because it can move crude, energy equities, and inflation expectations in one shot. Surprise draws can lift the complex. Surprise builds can deflate it. It's a catalyst this week because the energy tape has been jumpy. Also Wednesday, a U.S. Secretary of State meeting on mineral supply chains. The question is whether we see concrete steps to de-risk critical inputs for batteries, semis, and defense systems. Markets care because supply chain cooperation can change the investment climate for mining, processing, and downstream manufacturing. Real coordination can reduce tail risk and support the secure supply theme. Vagueness keeps the risk premium high. It matters this week because markets are connecting AI and electrification back to the physical constraint, materials. Wednesday night, Alphabet and Meta, both post-market. Alphabet's question is whether cloud margins and YouTube ads are holding up while AI competition intensifies and how heavy the spend looks. Meta's question is similar but sharper. Are ads strong enough to justify AI capex without spooking margins? Markets care because these are bellwethers for the ad cycle and for how investors will price AI spending across megacap tech. Strong results with controlled capex can support a broad risk-on impulse. Capex shock or ad softness can compress multiples and rotate leadership. They pop this week because they're core big tech prints. Every portfolio is listening.
Alphabet tells you the ad market. Meta tells you how expensive it is to defend it.
Add in Eli Lilly and AbbVie on the healthcare side. The question is whether healthcare remains the steady earnings anchor while other sectors trade on macro. Markets care because guidance can shift sector leadership and defensive flows. Strong prints reinforce healthcare as a haven. Weaker guidance pushes investors back into riskier growth pockets. It's relevant this week because healthcare can become the quiet swing factor under the tech spotlight. And you close Wednesday with the Noble Capital Markets Emerging Growth Conference. Mid-cap tech and energy firms pitching investors. The question is whether risk appetite is broadening beyond megacaps. Markets care because improving breadth is how rallies get healthier. Muted reception reinforces the narrow market story. It's a signal worth watching because megacap weeks often reveal whether the rest of the market has a pulse. Thursday is Central Bank Day, plus Amazon. First, the Bank of England decision. The question is whether the BOE leans stay tight or signals a shift. Markets care because it moves GBP, UK financials, and can spill into global rates sentiment. Hawkish surprise can lift yields and pressure risk. Dovish surprise can ease conditions and support equities. It matters this week because it's paired with the ECB. Then the ECB decision and press conference. The question is whether they reinforce higher for longer or acknowledge enough progress to soften the stance. Markets care because EUR and global bonds react, and Europe is too big to ignore in the rates complex. Hawkish tilts can pressure long-duration equities. Dovish tilts can support risk appetite. It's getting attention because stacked central bank decisions tend to manufacture volatility. Back in the U.S. at 8:30 a.m., jobless claims. The question is whether cracks are forming right before payrolls. Markets care because in weeks like this, claims are less routine and more last signal before the main event. Higher claims can trigger a bond rally and defensive rotation. Steady claims keep the market braced for a firmer jobs print. It matters because it's the final labor breadcrumb. Thursday night, Amazon. The question is AWS growth and consumer resilience. Two bellwethers in one report. Markets care because AWS sets tone for cloud demand and AI infrastructure narratives, while retail commentary shapes the consumer backdrop. Strong print can lift cloud peers and discretionary sentiment. Weakness can hit the whole enterprise spending story. It's in focus because it lands right before payrolls and after other mega-cap signals. You also have SiriusXM and Roblox as mid-cap consumer attention checks, plus ConocoPhillips on the energy side. For Sirius and Roblox, the question is whether consumers are maintaining subscriptions and digital entertainment spend or trimming. Markets care because it informs sentiment on ad markets and discretionary behavior. For Conoco, the question is discipline versus growth, how producers are thinking about supply and capex. Markets care because producer behavior shapes forward supply and can move both energy, equities, and the oil curve. These matter this week because they either confirm or challenge the macro story you've been building all week. And Thursday's Small Cap Growth Virtual Investor Conference is your breadth check. The question is whether capital is expanding beyond the mega cap core. Markets care because breadth is stability. Participation means healthier risk appetite. Silence means fragility. It's relevant because this week is a stress test for is the rally real or just concentrated? Then Friday, the anchor. At 8:30 a.m., non-farm payrolls. The question is whether the labor market is cooling at the right speed, enough to ease inflation pressure, not enough to break growth. Markets care because this one print can swing rates, equities, and the dollar simultaneously. Strong jobs and wages can push yields up and compress growth multiples. Weak numbers can rally bonds and risk, unless it reads like a hard landing warning. It matters because everything earlier in the week was basically positioning for this. At 10 a.m., Michigan consumer sentiment. The question is whether consumers feel better or worse, and whether inflation expectations are drifting. Markets care because confidence and expectations shape spending and rate narratives. Higher sentiment can support discretionary and lift yields if inflation expectations rise. Softer sentiment can do the opposite and complicate whatever payrolls just told you. It matters because it's the emotional follow-through after the hard data. Two global extras on Friday. The Milano Cortina Winter Olympics begin, and Skanska reports in Sweden. The Olympics are mostly cultural, but they kick off sponsorship and media cycles. The question is whether engagement supports ad and brand narratives. Skanska is an infrastructure bellwether. The question is whether backlog and demand confirm that real economy building is still alive. Markets care because both can quietly affect brand sentiment and cyclicals. They matter this week because investors are hunting for signals outside the mega cap echo chamber. And you are wake up ready.
Weeks like this punish tunnel vision. The moves come from the side rooms, not just the main stage. All right, knowledge bomb. Let's talk about something that quietly controls your life, your spending power. Not your salary, not your job title, not your side hustle, your spending power, how far your money actually goes. And three forces shape it more than anything else: deflation, inflation, and hyperinflation. Most people treat these like vocabulary words. They're not. They're three different economic climates, three psychological environments, three completely different rule books. Let's start with deflation. Deflation is when prices fall over time. On the surface, it sounds amazing. Stuff gets cheaper, money feels stronger, but that's the illusion. Because when people expect prices to be lower tomorrow, they stop buying today. They wait. Businesses see demand fade, hiring freezes, wages stagnate, investment slows, the economy doesn't explode, it quietly suffocates. Japan lived in this world for decades after the 1990s bubble. No apocalypse, just low growth, flat ambition, and an entire generation trained to expect less. In deflation, your cash feels powerful, but your future gets smaller. Now inflation. Inflation is when prices rise steadily, 2 or 3% in healthy systems. That's normal. That's motion. That's incentive. It nudges people to invest instead of hoard. It rewards builders. It keeps capital moving. But when inflation runs hot, you feel it fast. We saw it after COVID. Groceries jumped, rent jumped, insurance jumped, energy jumped. Suddenly, cheap disappeared. Your paycheck lagged behind. That's inflation under stress. And here's where people get confused. They think owning assets automatically protects them. It doesn't. Inflation quietly eats real returns, even when markets rise, turning nominal gains into illusion and making stocks behave like low-yield bonds in disguise. Inflation is a tax you don't see. It doesn't show up on a statement. It just drains your purchasing power over time. Now layer in Rick Rule's insight. Bull markets don't move in straight lines. In the 1970s, gold went from $35 to $200. Then it collapsed 50%. Everyone panicked. Everyone bailed. And then it ran to $850. 3 separate 30% plus drawdowns inside a historic bull market. Same trend, different psychology. The point is simple. If you can't survive volatility, you don't get paid for being right. Every real asset cycle, gold, commodities, energy, emerging markets, even great stocks, comes with violent pullbacks, 20%, 30%, sometimes 50%. Not because the thesis broke, because human beings panic. That's why you have to prepare financially and psychologically. Know your portfolio well enough that a drawdown feels like an opportunity, not a threat. And know it well enough that euphoric spikes trigger discipline, not greed. Inflation environments amplify this. They make volatility louder. They turn normal corrections into emotional earthquakes. Now, hyperinflation. Hyperinflation is when money stops being money. Not weak, broken. Prices double in months, then weeks, then days. You get paid and rush to spend. Savings evaporate, contracts collapse, trust disappears. People flee into dollars, gold, crypto, barter, anything that holds value. We've seen it in Zimbabwe, Venezuela, Argentina. Money becomes theater. Society starts running on survival logic. That's not high inflation. That's institutional failure. And here's the deeper point. Each environment produces a different society. Deflation creates caution, low risk-taking, low ambition, waiting cultures. Inflation creates pressure, political anger, rate hikes, redistribution fights, but still systems, still rules, still structure. Hyperinflation creates chaos, migration, black markets, extremism, regime change, the social contract snaps. So here's the mental model. If prices are slowly rising, that's inflation, normal. If prices are falling, that's deflation, long-term danger. If prices are exploding, that's hyperinflation, emergency. And inside inflationary systems, markets don't reward comfort. They reward conviction and discipline. You don't win by avoiding drawdowns. You win by surviving them with capital and clarity intact. You harvest when crowds are euphoric. You accumulate when crowds are terrified. Inflation doesn't just hurt savers. It quietly punishes undisciplined investors who mistake nominal gains for real wealth. If you're building your life in your 20s and 30s, this matters more than almost anything else, because your biggest asset isn't your portfolio, it's time. Deflation wastes it. Inflation rewards it if you own productive assets and manage volatility. Hyperinflation destroys it. So when you hear people yelling about inflation online, ask 3 questions. How fast, for how long, and under what institutions? Then ask a 4th, more important one. Do I understand my portfolio well enough to stay rational when prices fall 30%? Because if you don't, you're not an investor. You're just temporary liquidity for someone who does. Your spending power is your freedom. Protect it, grow it, and don't let volatility steal it from you. That's the knowledge bomb.
You ever notice how every financial influencer these days sounds exactly the same? They all start with that soft, breathy opener, like they're about to confess something emotional. Guys, we are living in unprecedented times. Unprecedented. As if the Romans didn't say the same thing right before the aqueducts started leaking and the barbarians showed up with better Wi-Fi. And then, Right on schedule, they hit you with the 3 magic words that are supposed to make you feel smart. This time it's different. Yeah, this time it's different. Just like every other time it was different. Dot-com bubble? Different. 2008? Different. 2021 meme stock casino? Extremely different. And now, in 2026, we've got AI eating the world, tariffs playing whack-a-mole with supply chains, and central banks pretending they still control interest rates like it's a dial on an old thermostat. Like, no, just turn it to comfortable. That should fix housing. But sure, this time it's different. Here's my deadpan hot take. The real unprecedented thing isn't the macro. It's how quickly we've all agreed that volatility is now a feature, not a bug. We used to call crashes corrections. Now we call them healthy resets. We used to panic sell at -20. Now we post screenshots of -20, like it's a badge of honor. Still holding, still breathing, still spiritually aligned. If this keeps going, in 10 years, people are going to brag about 80% losses the way CrossFit people brag about burpees. Bro, I held through the great AI deleveraging of 29, lost 92% of my net worth, but my conviction is up 300. And don't get me started on the new taxonomy of investor personalities. We've got the perma-bull. Everything only goes up because innovation. Doesn't matter what it is. AI toothbrush? Bullish. Then the perma-bear. Everything's about to collapse because debt. They've been predicting the apocalypse since 2014 and somehow never miss a podcast episode. Then the crypto monk. Lives in a van, owns only sats, judges your 401k like it's a moral failure. And my personal favorite, the index purist. Calm, disciplined, rational. Quietly judging everyone else, while secretly refreshing their brokerage app every 3 minutes, hoping nobody noticed they bought that one spicy small cap last quarter. Look, I'm not saying any of them are wrong. I'm just saying they're all exhausting. And the funniest part? The market doesn't care. It doesn't care who read the most threads. It doesn't care who built the best spreadsheet. It just keeps doing its chaotic little dance while we all pretend we saw it coming. So here's the only investing advice that has never gone out of style. Assume you're probably wrong, but stay invested anyway, because being early is indistinguishable from being wrong until you're suddenly right. And when that happens, that's when you get to post the victory lap screenshot. Just don't call it unprecedented. We've been here before. Thanks for humoring me.
And now for the greater debate. The room is quiet in that way that only happens when people know they're about to hear something that might ruin a few dinner conversations. 2 lecterns stand under soft lights. No slides, no charts, no safety rails, just ideas, debt, and consequences. Tonight's question sounds technical, almost boring, until you realize it's about your savings, your retirement, and whether the rules of money are quietly being rewritten while you're busy refreshing your phone. The question is simple to ask and hard to escape. Is financial repression the least bad way out of the global debt trap, or is it a slow-motion betrayal of savers and institutions? On the left stands Kenneth Rogoff, relaxed, hands folded, the posture of someone who has read 8 centuries of financial disasters and is no longer surprised by any of them. On the right stands Paul Krugman, alert, precise, eyes scanning the room as if he's already anticipating the objections before they're spoken. Rogoff speaks first, calmly, almost apologetically. He doesn't start with ideology, he starts with arithmetic. When debt climbs past 90 or 100% of GDP, he says, history narrows your choices. You can slash spending and raise taxes until voters revolt. You can default and destroy credibility. You can pray for miracle growth. Or you can quietly make debt easier to carry by holding interest rates below inflation. That's financial repression, not pretty, not heroic, but effective. He reminds the audience that after World War II, the United States and Britain were buried under debt. Instead of collapsing, they capped rates, nudged inflation higher, and let time do the work. Year after year, debt shrank relative to the economy, not through drama, through patience. Savers lost purchasing power. Governments regained breathing room. Societies rebuilt. He calls it a second-best solution, used when first-best options are politically impossible. He leans forward slightly. No country chooses repression because it's virtuous, he says. They choose it because everything else is worse. In high-debt eras, markets don't get a vote. Demographics, geopolitics, and fiscal math take over. You can resist it. You can complain about it. But you probably can't avoid it. There's a murmur in the audience, a few nods, a few crossed arms. Krugman responds without raising his voice. He agrees with the history. He doesn't dispute that repression worked after the war, but he says context matters. Back then, institutions were trusted. Inequality was low. Growth was strong. People tolerated sacrifice because they believed the system was fair. Today is different in the ways that matter. Modern repression isn't a coordinated reconstruction project. It's fiscal dominance. It's when central banks stop asking what's good for stability and start asking what's affordable for governments. It's when monetary policy becomes a financing arm of the Treasury. Once that line blurs, he says, it rarely snaps back cleanly. He points out that repression is a hidden tax. No debate, no vote, no line item on your paycheck, just erosion. It punishes savers, retirees, and anyone without leverage. It rewards borrowers, asset owners, and governments. Over time, it reshapes society in ways people don't consent to. Rogoff doesn't flinch. Of course it's a tax, he says. All debt reduction is a tax on someone. Austerity taxes workers, defaults tax creditors brutally, inflation taxes savers gently. Repression spreads the pain thinly over decades. That's why it works. It's politically survivable. He gestures toward Japan, toward Europe, toward the United States. High debt plus aging populations equals low rates for a long time. Banks will be nudged to hold government bonds. Pension funds will be encouraged to be patriotic. Yield curves will be managed. It won't be announced. It will just happen. And he adds something that makes the room still. Repression doesn't mean stagnation. After World War II, stocks boomed, businesses expanded, living standards rose. You can have financial repression and prosperity at the same time if institutions are strong enough. Krugman counters quickly. Japan is his Exhibit A. Decades of near-zero rates, massive bond buying, endless accommodation. And what did it buy? Low growth, weak productivity, zombie companies, a society afraid to take risks. That's repression's modern face, he says, not renewal, drift. He argues that advanced economies still have better options. Modest deficit reduction, smarter taxation, immigration, productivity investment. These are boring solutions. They don't make headlines, but they preserve institutional integrity. Repression, by contrast, trains politicians that debt doesn't matter. Someone else will absorb the cost later. There's a ripple of applause. Rogoff waits it out. Then he delivers his sharpest line. You're assuming politics works the way textbooks say it should, he says. It doesn't. Voters hate visible cuts. They punish honesty. They reward postponement. Repression isn't chosen because it's elegant. It's chosen because it's the only option that survives elections. He points to rising interest expenses, to aging electorates, to geopolitical competition. You think governments will voluntarily run surpluses for 20 years? He pauses. No one answers. They never do. Krugman fires back with his own knockout. Once repression becomes normal, he says, exit becomes impossible. You can't normalize rates without blowing up budgets. You can't shrink balance sheets without triggering crises. You become trapped. Monetary policy becomes hostage to debt. And when inflation finally breaks loose, you won't have credibility left to stop it. Silence, a cough somewhere in the back. Rogoff acknowledges the risk. He admits repression can slide into stagnation. He admits it can entrench inefficient systems. He admits Japan is a warning. But he insists the alternative isn't a clean reform renaissance. It's fiscal panic. It's forced austerity. It's social unrest. Repression is the bridge that keeps societies from falling into that canyon. Krugman, in his moment of honesty, concedes that rapid debt reduction is politically brutal, that voters resist pain even when it's rational, that perfect policy rarely survives contact with democracy. But he warns that normalizing repression normalizes quiet confiscation. It teaches citizens that rules are flexible when governments are uncomfortable. The exchange accelerates. Rogoff frames repression as risk management. Krugman frames it as institutional decay. Rogoff sees history repeating. Krugman sees history misread. Rogoff trusts slow erosion more than sudden collapse. Krugman trusts transparency more than subtlety. They circle each other on inequality. Rogoff argues that mass unemployment from austerity is worse than slow savor erosion. Krugman argues that stealth taxes concentrate power and wealth. Rogoff says repression buys time for reform. Krugman says it removes incentive for reform. Near the end, both slow down. Rogoff admits that repression without reform is a dead end, that it only works if governments use the breathing room wisely. That too often they don't. Krugman admits that politics often blocks clean solutions, that ideal fiscal management is rare, that some form of accommodation may be unavoidable in crises. They look at each other not as enemies, but as veterans of too many cycles. I step forward. What hangs in the air isn't who won. It's the trade-off no one escapes. Financial repression isn't a villain or a hero. It's a coping mechanism, a pressure valve, a way societies postpone reckoning. Used briefly, it can stabilize. Used lazily, it corrodes. It protects governments. It taxes patience. It rewards leverage. It punishes stillness. It's not about whether it will happen. It's about whether anyone will notice before the bill is paid. And that is the greater debate.
Let's invent again. In the early 1960s, in a basement lab at the University of Illinois, a graduate student named Robert Wilson was working on something nobody thought was important. A screen. It flickered. It was dim. It had no memory, no persistence. Early computers didn't feel like tools. They felt like suggestions. And that mattered because upstairs the university was building Plato, a networked learning system decades before the internet. Students could interact with machines, lessons could be delivered digitally, feedback could happen in real time. Except the interface barely worked. The bottleneck wasn't software, it wasn't computing power, it wasn't networking. It was the glass rectangle in front of your face. Wilson, working with Don Bitzer and Gene Slatow, wasn't trying to reinvent television. They weren't thinking about living rooms or home theaters. They were trying to make education usable. They needed a display that didn't flicker, that was bright enough to read, that didn't forget its image when the signal dipped, that could hold a picture without constant refreshing. They needed memory in the screen itself. At the time, that sounded backwards. Displays were supposed to be passive. You sent electricity in, you got light out. They asked, what if the screen could remember? They began experimenting with plasma, ionized gas sealed between glass plates. Each tiny cell could light up and hold its state. The early versions were ugly, power-hungry, hot, expensive, prone to burn-in. But they worked. They were stable, bright, readable, persistent. By 1967, their plasma display won a major industrial research award, not because it was elegant, but because it solved a real problem. It made computers usable. It made digital learning practical. Wilson never became famous. He built a quiet engineering career. Later, he became a pastor in Oklahoma. No celebrity inventor arc. Meanwhile, plasma displays kept improving. Power fell, color improved, viewing angles widened. By the late 1990s, they were everywhere. Homes, airports, sports bars. They were the first real large-format flat screens. Before LCD was cheap, before OLED was ready, plasma was the bridge. They succeeded because they solved the right constraint first. Most displays were built for broadcast TV. Plasma was built for reading, interaction, and learning, for usability. That distinction mattered. Most failed innovations aren't bad ideas. They're answers to the wrong problem. Bitzer, Slatow, and Wilson didn't ask how to build a better television. They asked how to make learning work on a machine. That framing shaped everything. You see it everywhere. Cloud computing worked because it was flexible. Smartphones won because they were intuitive. AI tools are spreading because they're finally becoming usable. Innovation follows bottlenecks, not headlines. Eventually, plasma faded, LCD got cheaper, OLED got better, energy efficiency mattered more. That was normal. Most bridge technologies disappear. That doesn't make them failures. it makes them necessary. Without plasma, flat screens arrive later. Without flat screens, mobile computing slows. Without mobile computing, digital platforms lag. Progress moves through handoffs. There's another lesson here. They weren't trying to disrupt anything. They were trying to fix what was broken. Plato wasn't a startup. No pitch decks, no valuations, no branding, just engineers dealing with friction. And in doing that, they created a category. Today, flat responsive screens feel inevitable. They weren't. Someone had to care about flicker, about dimness, about persistence, about users when everyone else cared about manufacturers. Breakthroughs don't start where attention is concentrated. They start where frustration is ignored. So when you think about startups, infrastructure, or AI, remember a graduate student in a basement trying to make a screen readable. He wasn't trying to change the world. He was trying to make something usable. And that was enough. The lesson isn't to be first, famous, or dominant. It's to find the constraint everyone tolerates, remove it, and let the system grow. Even if history forgets your name. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the full arc, from signal over noise, systems over stories, friction over fantasy. Big themes become real when they hit budgets, behavior, and belief. Trust turns into a product, and progress comes from patient people fixing practical problems. In markets and in life, the first principles stay simple. Notice the constraint, name the cost, then build the bridge.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious.
Stay kind.
And keep compounding.